Guys, this is the best investing book you never heard of. As a disclaimer, none of what we say should be taken as financial advice. This is purely educational.
Guys, there's some good news. We will be giving a free giveaway of our FIRL Pro program, which is worth more than 2,000 ringgit. And you can participate in getting it in the description of the comments where you can find the details. The deadline for this participation will be the 6th of March. So time is running out. Let's get to it.
Okay, MJ. So,
Yes.
The Hidden Truth of Stock Market by Ng Tzyy Loon. Now, I believe you have read through all the book and then you also summarize it into 7 must-know points.
Correct.
Right. So, the first point we have here is hold forever. I think this is the general statement that most value investors believe. And yeah, please take us through what is this hold forever.
So to start off, this is Mr. Ng Tzyy Loon is actually a colleague, co-worker of Han from TradeView. So a lot of books coming out of that.
Nice.
Asset management company.
Just curious, are they brothers?
You know what? Why don't let me ask them? I need to ask.
I mean, because they have.
But I don't think
right?
they are. But maybe I can ask. So yeah. So now, what is very interesting about this book is that it initially, when I looked at the title, I thought it was straight out of some scammy investment gurus, webinar or something like that, right?
Yeah, get it.
But when I when I opened the book, I realized that this book is it's definitely not scammy, and a lot of things actually that I excluded from this video. Because there's just so many good stuff, right? So, but here are some of the 7 that I think that you definitely need to get your head around. Okay, so the first one is hold forever. Now, this is very important because many people, when they start their investing journey, they will learn from Warren Buffett, from all these expert investors about how forever is their favorite holding period.
Yeah.
And in theory, that is true, right? You want to hold on a stock that you can or you want to buy a stock that you can hold on forever, or you don't want to sell. That's the ideal, right? And it just grows 20-25% every year. Unfortunately, there are 2 obstacles. The first is that companies change, right? If you look at your portfolio today, let's say there's 10 stocks, right?
Yeah.
And then you just go back 10 years and look at the numbers, look at the management, look at their strategy and plans, you will realize that it's very, very different.
Yes,
100%.
So
by extension, in 10 years' time, the companies that you currently holding will look very different as well.
Yep.
And as such, that makes it very difficult to hold forever. In fact, I would say it's close to impossible.
I believe Warren Buffett also mentioned this in his newsletter. I think it was in 2021.
Yes.
Basically, he did a comparison between the current companies, the top 10 largest companies.
Oh, yes.
Versus I believe it was 50 or 100 years ago.
There you go.
Yeah. And it was totally different.
Yeah.
Yeah, in terms of the largest
even for Warren Buffett, right? I mean, the recent news, TSMC, I think he hold it for less than 6 months, maybe.
Oh, yeah. Yep.
So, I mean, yes, of course, there's a Coke where he has held it since 1988 or 1989. Then, of course, there's Berkshire Hathaway holding it since 1965. But yeah, it's a bit of a hope for a lot of investors that they can just buy. Of course, I pray that you can find something like that, but don't hope for it. Now, the second thing is that even if, let's say, the company doesn't change, right, it cannot grow forever.
Yep.
I think that's very important.
Yeah.
Eventually, especially if they are good, there'll be a limit.
Yeah, it's always a cycle. There is going to be a growth phase, the introduction phase, then a growth. Then you hope your company to grow until and stay at a maturity stage for a very long time. You don't want to hope it suddenly go down to the declining stage. Yeah,
so what's very difficult with this, if you think about it realistically, is that the factors that will give someone the confidence to hold forever usually means that they need to have somewhat of a long history, right? Then it gives a sense of certainty and comfort. But for you to achieve that, it means, right, that the probability that the company is in the mature end of the cycle is a lot higher. Logically, right?
Yep.
Right, let's say you say, I need 10-15 years of data and consistency and profitability or whatever. to say this is a whole forever company. Well, it's 10 or 15 years gone that you cannot take advantage of. So you essentially have to hope the next 10 or 15 or 20 or 30 or forever years will continue to do well, which can happen, has happened, but know that it's an uphill battle.
Yep, 100%. Okay, so this is the first must know point, which is hold forever. I hope you guys learn something from this segment. Okay, the second point here is entry point equals profit.
Yes.
Okay, so I think you put here a quick small description. Think of entry more than exit.
Yes.
Wow. Okay, please take us through. What does this mean?
So a lot of investors like to think about exit. Like, when do I sell? Right? Is it too high? Is it too low? Am I catching, whatever. What Ng Tzyy Loon is saying is that the harder you think about when you enter, the less you need to think about your exit. Right? If you buy a company that is undervalued and unpopular, there's a high chance that you've got a good entry point. A good entry point means you don't have to think of the exit plan so hard, because if your entry point is good, you are choosing between, let's say, selling at 150% gain or 120% gain.
Yeah, and
right?
chances are you also will be regret selling it.
Yeah.
If you got into like a very good business and it's undervalued.
Yes.
Yeah, I think that's what happened to me when I discovered Ken Hing.
That's story for another time, I guess. So the entry point renders the analysis for exit or the stringent analysis for exit a lot lower, a lot less relevant. Does that make sense?
Yeah.
Right?
Somewhat.
You don't have to think so hard about the exit.
Yeah.
Because even if, let's say, you miss selling at the top and then it drops down 10-20%, whatever it is, and you want to sell there, hey, you're still in profit. But if you never think of your entry point and you simply buy because of hype or whatever, then your entry point is a lot higher.
Yeah.
Which means, then you have to think a lot harder about your exit.
Yeah. It's always about the margin of safety.
Correct. Which we will talk about later on as well. Yeah, there'll be a point.
Okay.
Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it.
Okay, the third point here, it's very interesting. Syndicates. All right. So I believe this is not to say not so well known to the market. I mean, everybody know that there's a big, they call it big operator, retail investors.
Yes.
Yeah, so actually it's quote unquote a syndicate. And yes, so it is a conspiracy theory.
Yes.
And you mentioned here is retail's worry. Why is that?
Yeah, so a lot of, especially carrying comment on Malaysia, they like to figure out what the syndicate is doing or whether or not there's a syndicate. And there's always a conspiracy, right? Like if the stock pump a lot, it's syndicate. The stock falls a lot, syndicate, right? So a lot of retailers use a lot of brain space to figure things like this out. Or is the syndicate in? Who's the syndicate? When is the syndicate coming in? Things like that.
Yeah.
This creates a lot of anxiety, and I think rightly so. And what the book is suggesting is actually there are many ways to go about this. If you want to avoid them, these are the key criteria. I didn't put all of them in, but these are these are 4 that I think is very important. The first is you need a big market cap, because syndicates only have so much money, right?
Correct.
To control the number of shares and, playing
usually big market caps are hard to quote unquote manipulate.
There you go. Second thing is high free float. So by law, I think Malaysia needs 25% of its shareholders owned by the public. So if the free float is like 40%, even harder. We're owned by a lot of retailers. Now the second thing, of course, is management integrity. That goes without saying.
Yep.
And the last one, which is very interesting, is high stock price. So prices that would not attract retailers, ironically, which is, the Nestle's of this world, the Dutch ladies,
the MPIs
of this world, $40, $150, things like that. Typically, they attract institutions. Yep. Because again, the math is very clear, right? You can only buy 100, at a minimum, 100 shares in the Bursa Malaysia stock market. You do the math, like take Nestle for example, it means that minimum you need to spend like 13, 14K, which a lot of retailers don't have.
Correct.
And so what the book also talks about is, look, why are you focusing on all these conspiracy theories and who's in, who's out?
Yeah, the dragon flow chart, the banker stocks banker chips are in, red color bar. I see that a lot of chart. I see that a lot of times.
Yeah, man. So you know it better than me, right? And the fundamentals is key, right? Because even if, right, there's syndicates involved, actually, right, I would say if the fundamentals are good and syndicates are involved, that is to your advantage.
Yes. Yep, 100%.
So even syndicates, they have a lot of money,
yeah.
Right? They have millions. And you as a small anchovy or ikan bilis, you are able to take advantage of low free float or low liquidity companies.
Yeah.
And be early.
Yeah. And better if you manage to get it way before the syndicate appear.
Exactly. That would be the best ideal, time. Right? Yeah. So,
But generally speaking, retail investors won't pay attention to these kind of companies. I mean, if they see a company that has been like consolidating for years or even going down, right? They won't even pay attention. They only start to pay attention when the price start to have like some sort of movement.
Which is a shame. Which is a shame.
Yep.
So, yes.
All right. Okay. So the fourth point here is speed. All right.
So this is more for people who are analyzing companies a lot. And what he brought up, so he used to be in the fund management industry. And what's very interesting is that his bosses will keep telling him, hey, you need to be up to date on so-and-so company and you need the speed of information to make decisions. What he started to realize is that he started being very scatterbrained, right? Like, it's all over the place. And he doesn't develop a strong understanding on the industry. He doesn't, develop understanding on, the true factors, long-term factors of a company. And he likened it to figuring out the weather and figuring out the climate.
Okay.
So for example, if I ask you today whether or not, like, okay, tomorrow, let's say, will it rain or will it be sunny? I mean, you can take out your iPhone and guess, right? Even if for iPhone, it's a guess only.
Yes.
But as for climate, let's say the general warming of the earth.
Yeah.
If I ask you in 10 years' time, will it be warmer? What's your answer? Yeah,
probably. Yeah.
Right? So it's easier to figure out the climate than the weather. So same thing. When you go, and this is also for retailers, when you try and find all the biggest news and see what you can take advantage of, that's like trying to figure out the weather rather than the climate.
Yeah.
So you get a lot less certainty when you try and figure out the weather. Or the example is trying to figure out which company is going to get the contracts, right? So when budget come out, what's the first thing people ask?
What stock? Which company or industry will benefit the most? Yeah.
But imagine if they use that brain power to learn about modes, right? To learn about, hey, what's the long-term prospects? What are the competitors like? Is it a monopoly situation or is it a red ocean? Things like that.
How recurring those revenues are.
Correct. And so his tip was to do this, right? In any industry, you split all the companies, right? And so in Malaysia, my guess is the typical industry listed in Malaysia has maybe 15 to 25 companies. Give or take. I mean, some were more like tech will have like 70 at the minimum. But take an industry and then split them into 3. Top, mid, and bottom. Ignore the bottom. Only focus on mid and top. What is mid and top? So top are the guys who are, rain or shine will make money consistently.
Okay.
So case in point, let's say oil and gas.
All right, oil and gas.
So Dialogue, for example.
Okay.
Right? Focus on understanding those companies. And then the middle tier. So the middle tier are guys that have solid fundamentals as well, but they are a bit more cyclical. So they are a lot more sensitive to oil prices, let's say. But the bottom one is just absolute rubbish, which you should avoid. Now, of course, having said this, certain bottom companies would do extremely well, stock price-wise, price action-wise. But that's, again, focus on what?
Yeah. But just to add a little bit, a small point on the bottom part, right? Sometimes bottom companies can upgrade to mid or top once the management start to turn things around. So yeah, you don't want to just like neglect. Like let's say when you shortlist a company, then you see like, hey, this company is bad. rubbish, just throw away. You may want to like keep it in your watch list because you never know whether things will turn around.
Exactly,
So,
yeah. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, so the next one we have here is business owner mindset. Okay, I think this is very straightforward. But as most retail investors participate in the market, right, they are always looking at the price chart.
So actually, this point is very interesting.
Okay,
he's saying that you actually cannot fully think like a business owner. That was his point. Yes, because he say, look, if you think you're like Warren Buffett and you can buy all these companies and like a business owner. First of all, you're not owning the business.
Yeah,
you don't
100%.
own it, like you don't control it.
You're not in a board of directors.
Exactly. You can't direct things. Now, why I use, if you can see on the slide, buy below NTA. Why is it there? The reason is because a lot of people, when they start out investing and they learn about how they need to be business owner, then they start thinking, hey, NTA is assets, right? NTA is money, right? There's value to it. And if NTA is a lot higher than the company, imagine if we liquidate everything, it will be worth more than the market cap.
Yep.
True.
Yep. Mathematically speaking, yes.
But what was the key phrase? If you liquidate. Now the question is, how do you liquidate? The only way to do that is to own our company outright or to be a majority shareholder and say we're going to liquidate. But if you're not, then how?
Yep.
So, but you are small. So this is an adjustment. This is not saying don't think like a business owner.
Yeah.
But this is more like saying, look, I need to think like a business owner so that when I look at other business owners, I can figure out whether he's good or not. Then if he's good, I bet on him. If he's not good, then I don't bet on him.
Right. And also you need to know how the period or how long does it take to liquidate.
Yeah. I mean, the classic is a lot of the companies trading below NTA in Malaysia are all like property companies with a lot of land.
Yeah.
And they don't intend to sell that because they got their land from their akong's akong for like 1 cent per square feet or something like that.
Yeah.
Right?
Yeah.
And they say, why you need to sell? Right?
Yeah, it's a cash flow generative land. So
No. Sometimes even if the land is just there.
Oh, okay.
It's unproductive.
Okay.
Then, of course, you as a shareholder, you're like, hey, sell it so you can pay a dividend, right?
Yeah.
Say, why? Don't need. Right?
Right.
So, but you're not a business owner.
Yeah.
So that's what the book. Of course, guys, go read the book.
Yeah.
To get more details.
This is very interesting so far.
Yeah.
Okay, so the next point here, CCC.
Yes,
is this what I think it is?
Yes,
cash,
this is the cash flow. Yeah, so this is very simple. This is a quick one. You know, as an investor on the technical side of things, you always want to look at this.
Yeah.
Right. So CCC is just, DSO, which is sales. Forgot the O already.
Yeah.
So anyway, DSO minus DPO plus DIO. So DPO is the payables. And then inventories is high.
I believe this one, it is just a layman's term of how to explain
Yes.
CCC. It's the moment when you get the inventory, how long does it take for you to convert that inventory into cash?
Yes.
Yeah. How fast?
So O stands for outstanding.
Yeah.
And really that's it, right? And in fact, so how this works is, let's say, even if the cash conversion is high or low, right? You need to go in and see like why is it high.
Yeah.
So typically what we like is when DSO is very low and DPO is very high.
Okay. Yeah. Payables are high. Yeah, makes sense.
I want the money to come in fast, but I want the money to go out slow.
Yeah.
And the DIO should be low.
Yeah.
Because I want to clear my inventory. By and large.
Yeah.
Sometimes it is much better to have a higher DSO if you can secure a better client. Naturally.
Like tech companies are.
Yeah.
Generally, they are all
Correct.
high DSO.
I have a friend who runs almost like 60-year-old packaging company up north in Malaysia, Semenanjung, Peninsula. and they are one of the clients of Penang. There's something like, I wouldn't say they're Kenju, but they do packaging for Nestle.
All right.
And Nestle say, yeah, we'll pay you in 6 months. Take it or leave it. You take it because you're like, I have to.
Yeah.
So you have to push and say, can you pay? But then, how does Nestle make money, right? They go to the mamak.
Yeah.
Whatever, say pay me now or pay me in 30 days. So 30 days versus 6 months. Very, very good.
Yep. I think another example would be the Mr. DIY.
Oh yeah. There you go.
Yeah.
There you
the
go.
one that they just say that, you know what? You just give me like this item, I can help you sell it like within like this certain period of time.
Exactly.
Yeah.
Exactly.
And they managed to execute. So yeah, that's one of the mode or even competitive advantage
there you go.
that Mr. DIY has. Okay. We're back to margin of safety.
Yes.
Yeah, this is something I love a lot. Okay, so wow, 30 to 50% is ideal. Okay. Did he explain further about this?
No, he just so the reason is because he thinks 20% declines are normal.
Okay.
So when you buy a company, it should be at least 30 to 50%.
You know, that's the irony. The irony is that people think that 20% is a drop, is a market crash. 10% drop is just a correction. But in the book, 30-50% drop is ideal. Wow.
So to be specific, he's saying 30-50% undervalued.
Undervalued.
Yes.
Okay.
So if the car you think it's worth one, buy it at a minimum, 80 cents or 70 cents.
Okay.
You know what I mean?
Right. Okay, got it.
So now at the flip side is to not be too conservative. So understanding the 30% is understanding the 50% is as important as the 30%. Why stop at 50% is because, again, very few times in history where the decline is more than 50% as well.
Yeah. I mean, Howard Marks also mentioned this a lot. If you discover a company that is undervalued, the intrinsic value and the price that you pay, it's very wide and it's cheap today.
Yeah.
But it got, and then you buy it at that price.
Correct.
And then it got cheaper the next day. You should be more happy instead of like, you should be happy. Yeah.
So
yep. Okay. I believe those are the 7 points of the 7 must know about the hidden truth of stock market. I still love the title.
It's the best.
It's the best. Okay, so if you guys want to read more about the book, we put the links in the description or in the comments below so that you guys can check it out for yourself. But before you go, this is the FIRL Pro's performance for the January 2023, and we're going to be disclosing the February one in a week or next week, depending on when this video is coming out. But just a hint, stock A actually grew more than 2x already.
Yes.
Yeah, and we also got another company that is going to be in our portfolio. I believe that one also is around like 80 to 90% gain.
Yeah.
So if you guys, you want to find out more what stocks we are even holding or our reports on those companies, please check out FIRL Pro program. And if you're still not convinced about it, you can actually access to our free sample. The links to this free sample is in the description and in the comments below. And don't forget about the giveaway, because we're going to be giving you one free FIRL Pro if you're the lucky participant who managed to get it. So yeah, make sure to join in.
The deadline is on the 6th of March.
Yes. Make sure to register. As long as you register this free sample, you already participating in this giveaway. So yeah, make sure to check that out. And MJ, any last words?
Now, as usual, guys, thanks for the support. Thanks for watching all the way until the end. Come watch some of our other videos, and we'll see you in the next video.